If you've held investments during recession or times of economic uncertainty, it's likely you've also experienced losing money from those investments. Often the guidance provided is to hold and to think long term. But as you know, it can be highly stressful during times of economic flux, and when you're in a downswing for too long, it can lead to impulsive action. You might exit your investments because you just can't take the stress anymore, and then, unfortunately, you end up missing out on the upswing. The reason clients are told to hold their investments is that the industry mainly invests by a concept called modern portfolio theory. The idea is that there is an optimal mix of stocks and bonds for a given level of risk, regardless of the investment environment. There are flaws with this approach, though. First, the market is viewed only in terms of stocks and bonds, when in reality there are four major asset classes: stocks, bonds, commodities, and currency. Second, there's a belief that diversification between stocks and bonds protects a portfolio because when stocks rise, bonds fall, and vice versa. The reality is that during periods of heightened volatility, most assets move in the same direction. Third, modern portfolio theory gives no consideration to the current investment environment, so regardless of the environment, an aggressive or conservative investor should maintain a fixed portfolio. Lastly, modern portfolio theory assumes that probable outcomes are evenly distributed, and they are not. At Client First Capital, we offer an evolved asset management solution that is adaptive. So where traditional asset management is like driving with cruise control from the early 2000s, where you would set a specific speed that stayed the same regardless of the environment, our solution is like adaptive cruise control, where your speed is adjusted based on traffic or hazardous conditions. The Client First Capital One Portfolio is built to preserve, protect, and compound investments because we follow a process that reduces risk in our clients' portfolios when the environment has a probability of high risk. First, we have to understand the investment environment that we are in using a math-based approach to track the rate of change in growth and inflation. Then, we overlay our framework to identify and contextualize the current economic environment. By understanding the economic environment, we are able to determine what assets have done well in that type of environment. And once we know what to own, we can then calculate the best time to buy by taking into account price, volume, and volatility. We then repeat the process to respond proactively to the changing environment. We invite you to learn more about the Client First Capital One Portfolio and how it may benefit your family's investment strategy using a math-based approach that proactively adjusts exposure to risk in different environments and is therefore better suited to manage downside risk than portfolios based on modern portfolio theory as used by many larger firms.